Hello, tax-savvy viewers. We're about to bid farewell to another year. Gosh, how can that be? We have less than a month left in 2023, which is exciting. However, because of that, it's time to talk about something that we all care about, and that's keeping more of your hard-earned money in your pockets. That's right. Today's video, we're diving into some year-end tax moves for you to consider for 2023 to keep your taxable income at a potential minimum. We want you smiling on April 15th, right? Don't you want to be feeling good about your tax return? There's only a few days left to take some actions, to consider some actions, to see if you can pull some levers, dial some knobs, and so on, and make some things better, right? Now, these are not just for the financial wizards of the world. This can be applying to anybody. If you're a business owner, if you're working for a company, if you're on your own, if you're retired, I'm going to share with you some areas that may apply to you. And you need to find out if these are going to apply to you by talking to your advisor. Now, this is not tax advice, not legal advice. Yes, I'm a financial advisor. Yes, words are coming out of my mouth. However, you and I may not have a client relationship. So really, this is just for education. Yet if you want to dig a little deeper to see, should I be doing this? I just want to get a confirmation. Reach out to your advisor. Feel free to reach out to me. You'll have an email address that you'll see at the end of this, but you can also see my phone number, my website there on the bottom. Okay, so grab your favorite beverage, cozy up, get a pen, get something to write down with, and let's uncover some possible smart strategies for you to pay less to Uncle Sam. Keep your moolah where it belongs, which is in your bank account, right? I am Rick Salmeron. I am a financial advisor for over 66,000 hours. Where did I get that number from? They say that doing something for 10,000 hours makes you an expert, right? Well, I guess I'm an expert times 6 plus. I got into this business in 1990. I, being the left brainer that I am, I calculated the approximate hours. Gosh, I've been spending 66,000 hours in this field. It's incredible. So I think I've seen a lot. I think I know a lot. I'm a certified financial planner, which is a gold standard in this industry. I'm president of my company, Salmeron Financial. Again, there's my website there down below. I've been on several podcasts, sought out by the news media. I'm seen as an expert in this field, and I hope to share some expertise to you today. Let's start with some easy stuff first, and that's maximizing your retirement plan contributions before the end of the year. What am I talking about? Generally speaking, employer-sponsored retirement plans like a 401k, like a 403b. There are certain dollar amounts that you're allowed to contribute up to a certain amount, and odds are a lot of people don't make it there yet. They come to, say, December, they've been putting away, say, a 6% or something, and that's really nowhere near what the maximum allowable is. So there's room to make additional contributions. We get into our mode of automatic pilot. I signed up for this years ago or the first of the year, and not really thinking about the dollar amounts, and frankly, maybe not even knowing or remembering what the annual contribution limit is. So keep in mind, you've still got space. You've still got time. Again, as I record this in December of 2023, there's time to make more contributions if you can. And the more contributions that you make into plans like these, the more you lower your taxable income. Specifically, everyone can put away $22,500 per year, up to that amount in the calendar year. If you've already hit that, great. If not, maybe you've got some more room to breathe to reduce your taxable income before December 31st. If you're above your age 50 or older, there's a catch-up provision that's called that you add on top of the annual contribution amount. That adds up to $30,000 for those of us, that's me also, who are at 50 years old or above. So we can sock away $30,000 that way. That's kind of nice. There's also the simple IRA. This is also for business owners. This is another tax deductible way to defer pay into a place. It's not a 401k, but this is more for the small business owner with a few employees, not too many, although I've seen some plans that have got several participants. But a simple IRA is another form of a tax deductible retirement plan that's got different limits. Its limits are less, $15,500 per year. Or if you're like me, adding $3,500 if you're age 50 or above per person. So if you're an active participant in a simple IRA, maybe your employer is doing this instead of a 401k. You can put away as much as that amount by the end of 2023. Now, why would an employer have a simple IRA versus a 401k or 403b? Short answer is there's complexity. 401ks are a little more elaborate, a little more in-depth, a little more moving parts, not as simple as the simple IRA. And as a result, you don't get as much of a tax benefit too. But there's reasons why one plan makes the most sense versus the other. If you're listening to this as a business owner and you're wondering yourself, wow, I wonder if I should be doing something else. That's a very good question to ask yourself. And so use this video as a means to consider, do I have the right plan or not? I wonder if I do. And if you want to know and speak with your advisor, you can give me a call. I'll be happy to assess what you have and compare what there might be. Maybe there's something better. Maybe there's a better shoe fitting your foot. Who knows? So there's the simple, they have its own annual contribution deadline of December 31st. Now, there are other retirement plans that have higher annual contribution limits. And guess what? There's not an end of the year deadline. Now, I bring this up just to expose you to consider what is possible if you don't have something like this. For example, there's a SEP IRA. Again, generally for self-employed individuals or a business owner with a few employees, but the annual limits on a SEP can be as high as $66,000. You can contribute as much as that in 1 year and have it tax deductible. The formula, generally speaking, is 25% of your net self-employment income. So if the numbers work, the annual amount you can contribute can be considerably high. There's also the solo 401k. Well, I'm on my own. I don't have any employees. I just saw that number with 401k. Gosh, can I take advantage of something like that? And the answer is yes. If it's just you, you can do, the 22,500 as we saw on the previous slide, but you can add as much as 66,000 in a solo 401k from a combination of your own paycheck deferrals plus the company's profits in the form of a profit sharing plan contribution. And like other plans, you've got the age 50 plus catch-up provision, adding $7,500 on top of this number. So as you can see, as I'm going down this list, the ceilings become higher and higher, don't they? And there's the cash balance plan. This is a very unique, very interesting vehicle. It works great in certain circumstances. How much can you contribute tax deductible in a cash balance retirement plan? Answer is to be determined. It's a defined benefit plan. I'm not going to go into the weeds of it. However, just know that with a cash balance plan, it is possible, again, depending on your company and your company situation, it is possible to defer hundreds of thousands of dollars tax deductible in a plan like this. Pretty incredible. Imagine what your pot of gold might look like and your tax return might look like by being able to tax deduct hundreds of thousands of dollars into a retirement plan that you've got going. That's very interesting. So consider all of these as options. Now let's talk about charitable strategies. Yes, donating to good causes where your heart meets smart. Kind of like that tagline. What am I talking about? So let's shift gears here with charitable strategies. They can make a real difference, not just to the world, but for your 2023 tax planning. For example, qualified charitable distributions. This applies to individuals who are at least 70 and a half years of age. If you have a tax-deferred IRA that's never been taxed before, you made pre-tax contributions into it throughout your years, and here we are, and it's grown and grown and grown, and you have the specter of required minimum distributions coming up here pretty soon. You can, and you have a charitable heart. I would suggest this is something for you to look into instead of simply, say, writing that check out of the bank account, sending it to your favorite church or the Red Cross or whatever 501c3 that is in your life that you want to support. Consider making a distribution from your IRA account instead. These are called qualified charitable distributions. You can transfer up to $100,000 if you're age 70 and a half or older. You can send those funds to that charity of choice. You're using pre-tax money to send to the charity, not your after-tax money in the bank. It's already been taxed before. Let's use pre-tax money. When that distribution is made to a charity, that distribution is not considered taxable income to you. So you can literally take money out of your IRA and not have it be taxed to you. This lowers your adjusted gross income. And when that happens, a lot of good things happen. You've got less tax you're facing on your tax return. You have the potential of minimizing the IRMAA tax. This is a Medicare assessment, a Medicare premium. Medicare will charge you more for your Medicare premiums if you're making too much money. And making too much money means you've taken IRA distributions and you've got reportable income here and reportable income there. If we minimize that, you lessen this IRMAA tax. Won't get into the weeds of that, but there's something out there called the IRMAA tax that you need to be aware of. It minimizes potentially the Medicare surcharge tax of 3.8%. If you make considerable amount of money, you could be charged with this. This could help lower that. And there's a better chance of you deducting your medical expenses. Right now, it's 7.5% of that adjusted gross income. And if you've got a low adjusted gross income, there's a better chance of you deducting medical expenses in that year. So if you are charitably inclined, and if you have an IRA, to sum this up, those are the two pieces that you need to keep in mind. If you're one of those persons that holds those two characteristics in your life, this is a possible option. Find out from your advisor, find out from myself, should I do this? Can I do this? There's also the donor advised fund. Ooh, this is a really nice one. I call this the charitable savings account. Just imagine, the Bill Gates Foundation, the Warren Buffett, these very ultra high net worth people who've got their own personal foundations, right? They want to make a difference in the world. They've got massive amounts of money in these, and they're doling it out to help this cause and support that, this and that, and so on. Imagine if you had your own personal, unique foundation. That is what the donor advised fund can do at a much smaller scale without the bureaucratic hassles and the filings of its tax returns and the rules and so on that one Bill Gates, like, for example, needs to abide by with their foundations of epic proportions. You can have your own, your private one, to help benefit charities of your choice. Just imagine creating a savings account that's tax deductible, that's charitably inclined. You make contributions into your donor advised fund. And when you do that, those contributions are tax deductible on your tax return to certain limits, but we can figure that out later. but you can make tax-deductible contributions before the end of the calendar year into your donor-advised fund. And that money goes into your donor-advised fund, and you decide later, it can be right away, or it can be later, where you want those funds sent out to, what charity or charities. So it's a very, very easy way to create a charitable pocket that you decide, and you make suggestions of where that money eventually will go to in various places for years and years and years and years. It's what I call your personal foundation. And instead of, there's a double tax savings idea with the donor advised fund. Instead of, say, donating or contributing cash out of the bank to your DAF, if you had highly appreciated assets, it could be a stock, it could be a piece of real estate, it could be whatever, you put in money into it a long time ago, now it's grown, consider taking that and making the donation to your donor advised fund. Why do that? Because not only, number one, are you getting the tax deduction on that contribution transfer, but the possible capital gain that that asset is exposed to, you don't pay tax on that either. You don't sell the asset, turn it into cash, make the contribution. Instead, you transfer the highly appreciated asset in kind, as it is, into your donor advised fund. The donor advised fund does the selling. It generates the gain. Guess how much tax it pays? Zero, because it's a charity in itself. So you don't pay that tax. It doesn't pay that tax. You've made the contribution. You can write that off on your tax return. It's nice. It's really nice. Now we have bunching deductions. Again, these are all suggestion strategies that you should consider before the end of this calendar year. Gosh, we've got a few days left. This is another way of saying this is deduction arbitrage. What am I talking about that? When we file our tax returns, we have the ability to take one of two types of automatic deductions from our income. One is standard deduction. It's a freebie that the IRS gives us, everyone, no matter how much or how little that we make. And then there's itemized deductions. And the itemized comprise of many different things. And if the many different things that we incur in terms of expense throughout the year adds up to more than the standard freebie coupon that the IRS gives us, we generally take the higher of the two to reduce our taxable income, right? Makes sense? So itemized deductions, that means I add up my charitable deductions for the year, the state and local taxes that I paid during the calendar year, up to the $10,000 SALT cap that's imposed at the moment, the mortgage interest, the investment interest expense that I incur throughout the year on my home, and the medical expenses that exceed that 7.5% of my adjusted gross income. You saw it in the previous slide. All right, so itemized deductions generally add up to all of these. And if this number is higher than my standard deduction, which is this for 2023, if I'm single, it's just under $14,000. If I'm married, it's just under $28,000, as those numbers reflect. And if I'm age 65 or above, I get to add single or married filing joint amounts there too. That's what those numbers are for. So I just compare. Now, what am I talking about? Deduction arbitrage. The lever that I can pull the strongest in my itemized deductions really is going to be charitable deductions. I'm limited on my property taxes, my state and local taxes up to $10,000. My mortgage interest expense, I lucked out. I got that 3% mortgage still. They're in control of the mortgage, not me. I'm going to pay what I'm going to pay in mortgage interest expense. My medical expenses, I really don't want those to get very high, right? Although they can. However, it's not something that I can voluntarily, just inflict bad stuff on myself and incur medical expenses. I'm not interested in doing that. However, I may be very interested in charity. So I can donate $10,000, $20,000, $50,000, and so on to charities. So what I'm getting at with the arbitrage is maybe I bunch my itemized deductions really heavy in one year. Maybe it's this year. Maybe it's in 2023. Again, we've got a few days left until December 31st. Can you really load up your charitable deductions really heavy this year so that it exceeds your standard deduction? Maybe they're already exceeded now. Who knows? I don't know. But if you load up on your charitable deductions so that they exceed the standard deduction, maybe you give to that charity twice, maybe once today, and in your mind, it's my 2023 deduction, my charity contribution to you for this calendar year, but maybe you do it times 2 and tell the charity, here's my deduction for this year and my deduction for 2024, all in one nice little check. By doing that, you can better exceed the standard deduction so that in 2024, when we're talking, you and I, say 12 months from now, you did the itemized deduction thing in 2023, you're taking the standard, you're planning to take the standard deduction in 2024. This maximizes the benefit of using these two potential avenues. All right. Let me know if that makes sense. I'm giving you a lot here, I understand. However, this is a strategy that is often overlooked, and it could easily be taken care of. And when you take advantage of it, it can make a big, big, big difference. Harvesting your assets, a year-end strategy to be considering. Myself, I like to look at this throughout the year. That's what I do with my clients. That many people just focus on December for some reason because it's end of the year and it's a topic of discussion, et cetera. It's a good strategy if it makes sense. Do you have something ripe to harvest? Do you have something? Do you have an asset? Do you have an investment? Do you have a stock? Do you have something that's sitting at a loss? It's not doing so well. You were hoping it would go up, it went down. And you're wondering, gosh, I don't want to, what do I do with this? I'm hanging on to it. Hopefully it will come back. That's your mindset. Yet there is a tax break that we all have with losses. We can use losses to offset any other gains that we have incurred during the year. Maybe you have had other investments that you sold at a gain, or maybe you have other investments that are at a gain that you have not sold yet, that because they're at a gain, you're exposed to paying tax on that gain. So what harvesting loss does is neutralizes the possible tax on a gain of an asset. I sell an asset for a gain, and then I've got this other loser that I can sell, generate its loss, and I'll apply that negative to my positive over here. I'm saving taxes on the gain. Now, suppose I've got so many losses, I don't have enough to offset all my gains. Well, here's where the nice $3,000 of unused losses rule comes into play. If you've got more losses than gains, you can just write off your tax return up to $3,000 of unused losses. That's just off. And this is not huge, but it's a benefit. It's a benefit. Your advisor should be watching for these types of things. Are you in a situation where you've got losses somewhere and gains? Let's do some harvesting to neutralize, okay? Or let's just generate some losses to minimize income, or both. Now, beware of something called the wash sale rule. If I sell that loss, You may be thinking, well, I can just sell it and tomorrow just take that same money and invest it back into the same thing. Can't do that. You have to wait 30 days before that happens. So there's a wash sale rule. You either have to take those proceeds and just sit them on the fence somewhere and hang out until 30 days passes, and then you can go back into what you were in before, or you can just take the proceeds, reinvest it into something similar, not the same, but similar. If you want to keep the money still in the markets or in the whatever that you had it in. Okay, so be careful of that. There's also harvesting gains. I mentioned about harvesting gains because you've got losses, but harvesting gains can also be looked at through a different lens. There is actually a 0% capital gains tax rate on gains up to certain income levels. If you're single and you're making around $47,000 or up to that $47,000, you will pay zero tax on capital gains up to that amount. Or if you're married, it's $94,000, filing joint tax return. So just imagine you're making, you and the husband, making $75,000 in income. You've got a investment somewhere that's showing a $10,000 gain. If you harvest that gain, guess what your tax rate is on that example? 0. So how do you know if you're a candidate for this or anything? You have to speak to your advisor. You have to reach out to them. Hopefully they're reaching out to you. If they're not reaching out to you, reach out to me. I'll take a look. Let's see what we can do. Not too much time left. I've got other people to work with on these things too, so my spots are filling up. Converting IRA money into Roth IRA money, meaning this is not a tax deduction per se. Actually, it's frankly increasing taxable income. I'm throwing this in because this is a year-end deadline type of topic to focus on. Roth IRAs allow you to pay less tax down the road. IRA money, you've got IRA money. It's never been taxed before. When you withdraw it, you pay tax. Roth IRA money inside, after tax contributions, tax deferred growth, as long as the account's been around for 5 years and you're at least 59 and a half years old, the withdrawals are tax-free. It's kind of nice to think of having something that's tax-free, right? Now, are you in a lower tax bracket today? Because when you take IRA money, you can convert it to Roth IRA money and get those tax-free withdrawal benefits that I described. But in order to do that, every dollar that you convert is taxable because it's coming out of the IRA. You're moving it into the Roth, but you're taking it out of the IRA. So when that happens, you pay tax on those distributions. So assess and consider, what kind of tax bracket am I in today? If you don't know, reach out to your advisor. Reach out to me. If you don't want to, reach out to your advisor. Are you in a lower tax bracket today? Does it make sense to pay really small amount of tax right now, knowing that you're not going to pay any tax later on? Right? The highest tax bracket today is 37% federal tax. The lowest is 10%. The idea of me paying 10 cents on my dollar is more appealing than 37 cents on my dollar. So we don't have crystal balls here. However, sometimes this is kind of an intuition, a guessing game of sorts. However, it does help to assess your numbers too and where you stand. Do you think that you'll be in a higher tax bracket tomorrow? I don't know. I don't know what the tax rates will be tomorrow when you retire. We don't know that. We can only make educated, informed decisions based on what we know the law to be today and the tax brackets to be today. And Roth IRAs, not a bad place to be leaving a tax-free legacy, because when you die and there's still money left in your Roth IRA, guess who still gets to receive the tax-free distributions? Yes, your beneficiaries. There's my last slide. I'm going to wrap this up. What I just covered are, generally speaking, some of the high-level strategies. You don't need to know all about them. You don't need to be an expert in all of them. You certainly can give it a try if you want. However, believe me, inside each one, there are a lot of different moving parts. Every financial transaction comes with it a tax implication. And as a CFP, it's important for me that you understand that making decisions or taking actions or not taking actions without a consultation of your advisor, it's not a good idea. So ask that person, or if you want answers and what of these things apply to me? What should I be doing between now? I really would like to know. Help give me some guidance. There's my email address. There's my website down below. There's my phone number down below. Feel free to reach out to me because I'm happy to help. I hope that this has been helpful, and I look forward to sharing more videos like this with you in the future. Have a great rest of the end of the year. Gosh, I can't believe it. We'll see you soon, if not in 2024. Bye.